Pretty much the biggest risk associated with writing covered calls is the possibility of getting your shares called away. In all the covered call tutorials out there, you rarely see this scenario emphasized. Not to get too psychobabbly on you here, but let's use one of our favorite examples to illustrate the practical and emotional component of this risk. There's a decent chance you own a little or a lot of the tech stock generating the most investor interest in our Trackstar database, Apple. If you own 100 shares of Apple, you can write a covered call against your position. You consider Apple a lifetime stock. You manage to accumulate 100 shares at a cost basis of $92 a share. Not too shabby. With the stock trading around $157, you're sitting on a 71% on-paper profit, not to mention the quarterly dividend reinvestments. But because you don't plan to sell ever, you crave more. You read an article about covered calls. You take the next step and decide on this. Apple trades weekly options. This one expires on Friday, September 30th. If you sold that covered call, you'd generate a handsome $2.36 or $236 in premium income. You keep this money no matter what. In these tutorials, you often hear about your effective selling price. The strike on the call option you sold plus the premium you received equals $162.36. Setting aside your original cost basis of $92 and isolating this trade, you don't lose money on paper if your shares get called away at $160 until Apple crosses $162.36. Considering your $92 cost basis, you're in even better shape. There's nothing wrong with buying at $92 and selling at $160, but really $162.36 thanks to that premium income. However, in our hypothetical here, Apple went on a run, blew past $160. You had to give up 100 shares at $160, so you no longer own 100 shares of Apple. Maybe after your dividend reinvestments, you're left with a somewhat demoralizing and wimpy 0.8 shares or something. Now you're left to figure out if, when, and how to buy Apple back as it soars higher. The bottom line is this. In the future, we'll detail how to guard against this potentially undesirable eventuality. For now, pay attention to strike prices and option expiration dates, and don't get too greedy. While you generate more income with a strike price closer to the underlying stock's market price, you also increase your risk of losing your shares. We'll get into the mechanics of this going forward, presenting different ways to approach the trade. Ideal situation, you own a boatload of Apple, say 500 shares. You might feel more comfortable with the risk-reward by repeatedly writing high-income producing covered calls on 100 or 200 shares, knowing that if they get called away, you'll still have a formidable position in your favorite long-term stock.